Hi, are you considering refinancing in 2026? Well, if you are, please do me a favor, take a few minutes, watch this video as I step you through some reasons why it may be a good idea for you and it may not. And we're going to use some simple math and doing a break-even analysis so you can determine if refinancing is the right decision for you. So let's kind of start with where we're at with regards to rates. Rates are definitely easing, so they're getting lower, but they're not necessarily low rates like we had during the pandemic. Back then, we had rates that ranged, 2.5% to 3.5%. And in some cases, I actually had clients that were able to refinance twice within that 2-year window that we had those really low rates. And that was because we were able to look at what their cost was versus what they were going to save, and they were going to recoup those costs really quickly. And that's what you want to be doing today, even if the rate savings isn't quite as great. It's a little bit more moderate, but it could still be financially sound for you to do it. So what do I mean by a break-even analysis? Well, it's really a very simple math equation. We're going to take your total closing cost, let's say it's $4,000, and then we're going to divide it by the monthly savings. Let's just say you're going to save $200 a month. So if we take the $4,000 divided by the $200 a month, that equals 20 months is your recovery period. That's how long it's going to take you to recoup those costs. If you're going to be in the home and not sell for 20 months or greater, well, then this can be a really great thing for you, even though it's only a $200 a month savings. $200 a month could go towards another credit card bill, or pay more towards your car loan, things like that. So this is definitely something that is good for you to consider, even if it's only $200 a month. But again, if you're able to recover it in a short period of time. So I mentioned closing costs. What do the closing costs include? Well, closing costs can include things like origination charges, discount points, appraisal and credit report, title and escrow fees. You're going to have recording fees. And then lastly, you're going to have what's called prepaids. Prepaids are if, for example, you have a escrow account for your taxes and insurance, we're going to have to reestablish that escrow account. We're going to have to reset that up. And then what's going to happen is when we pay off your existing loan, they're going to refund those escrow monies to you. So while this isn't really a true cost, it's just something that you have to factor in when you're looking at all of this. Because as the lender, if I'm setting up your new escrow account, I can roll that into your loan. We can calculate it where you bring that money into closing, since you're going to get it back from the other mortgage company. So there's definitely different ways to look at it. Like I said, with regards to the break-even analysis, I typically don't factor that in because it's essentially a wash between what we're setting up the new account for versus what you're getting back from the other company. So, but those are all still things that you have to take into consideration when you're looking at all of this. Now, I mentioned discount points. A good rule of thumb, regardless of if you're purchasing a home or refinancing a home, is if you're paying points, you typically want to be able to recover those points within about a 4-year period or less. Anything greater than that, and it really becomes kind of self-defeating to pay that extra money and it take that long for you to get your money back, if you will, through your monthly savings. So again, just kind of use that as a general rule of thumb. Now, there's several reasons why when clients come to me and we do this break-even analysis and we talk about refinances, I will explain to them, hey, this isn't necessarily a good idea for you financially. Some of those reasons might be the fact that they're going to sell the home in 2 to 3 years, move out. And so at that point, they may not want to consider refinancing because that's such a short period of time. Number 2, they might actually only save $100 a month or less than $100 a month when we do these calculations, and yet the fees are going to be very high. And so again, they're not going to recover it quickly enough. They also might have a relatively low balance. In other words, they've been paying on the loan for quite some time. Maybe they only owe $40,000, $50,000, $60,000. Well, oftentimes it doesn't make sense to refinance something like that because your difference in rate would have to be so great for you to recover it quickly enough. And also, if you're towards the end of your loan, you've paid the majority of the interest already. So unless you're thinking about doing it where you've got a low balance and now you want to take some cash out to pay off other debt, that's a whole different strategy, and that's something that we can discuss at another time. Now, reasons why, when I definitely tell people, yes, full speed ahead, let's get this done. Number one, they're going to recover those costs in, like I said, 2 years or less is typically what I recommend. Obviously, the shorter the period of recovery, the better, because if rates continue to improve, say in 2027, 2028, you could look at refinancing even again. Another reason why you might want to go ahead and do it is you're gonna be in the house for 5+ years. So even if it takes you just a little bit longer to recover those fees, it still might make sense. Again, going back to another reason why we might want to consider doing it, maybe you're looking at pulling some cash out, and that cash out is going to save you in terms of your monthly budget, because you're going to eliminate, say, $1,000 a month in credit card debt and car payments and things of that nature, and then your mortgage payment's only going to increase $300. So net, in terms of your monthly budget, you're ahead $700 a month. So those are some reasons why you definitely would want to go ahead and take advantage of a refinance if it makes sense. So I hope you found this information helpful. And if you would like for us to work up a break-even analysis for you, run some figures, figure out, does this make sense for you to refinance? By all means, please reach out. You can call us, text us. Typically, we just need a copy of a current mortgage statement and a few other questions answered, so we can kind of get an idea as to what you're looking to do and see what we can work up, and then do that break-even analysis for you, and where I can show you, okay, here's what your costs are, here's what your monthly savings is, here's how quickly you're going to recover it, and then you can make the decision. No high-pressured sales. We don't try and talk you into or talk you out of, although again, I will talk you out of a refinance if it doesn't make sense because you're not saving enough and it's costing you a lot of money, okay? You have a great day. If there's anything else we can do for you, just reach out anytime. Also, if you found this information helpful, please do me a favor, subscribe to our page here. That way you can continue to get our information as we release these videos. You have a great day. We'll talk to you soon. Bye-bye.